هذا البرنامج يأتيكم برعاية ATFX.
مع انطلاق شهر أغسطس شهدت الأسواق تقلبات حادة لم نشهدها منذ سنوات. انهارت الأسهم اليابانية وسجلت أكبر خسارة يومية منذ الاثنين الأسود في عام 1987، بينما خسرت الأسهم الأمريكية والأوروبية تريليونات الدولارات من قيمتها السوقية. هذا الأمر طبعا ترك الكثير من المستثمرين يتساءلون وأيضا في حالة من الذعر. هل تساءلتم كيف تحمون المحافظ المالية في مثل هذه الأوقات؟ نلجأ إلى السندات، نستثمر في الذهب، أم ننتظر بصبر حتى تهدأ العاصفة؟ في هذه الحلقة اليوم سنتحدث عن أهمية تنويع الاستثمارات، دور السندات والنقد، الحفاظ على الهدوء، وكيفية اتخاذ قرارات مالية حكيمة تحت الضغط. ومعنا ينضم لنا في هذه الحلقة اليوم بروفيسور جون ألكسندر، وهو رئيس الاستثمار في جامعة كليمسون University. Professor John, thank you for joining us on this episode today. And my first question to you, the first week of August, did you manage to get enough sleep when volatility was going over the roof?
Yes, it is interesting putting that first week of August in perspective. Historically, it's not unusual over the past 50 years, it's not unusual for the market to have a 10% pullback on a pretty regular basis. Currently, I guess we're down about 8%. It's interesting because you and I both know that was sparked by weakness in Japan relative to the yen. There's a little earnings disappointment mixed in there. There was signs of a weakening U.S. economy, and some, articulated through weak unemployment. So we were expecting a pullback. I'll be candid and tell you that this pullback came a little later than we were expecting.
Yeah. Professor, let me share with you this poll that we've asked our CNBC audience about. We asked our audience, what is the first action you take when significant market volatility occurs? And here is the results. The answers were sell some assets, buy safe haven assets, review and diversify your portfolio, or wait and take no action. And in fact, 52.8% went to wait and take no action. And I think you just had your investment committee meeting before you joined us on this show. So was it this action that you've taken, wait and take no action, or you did something else?
Historically, market weakness starts in May. And so back in April, we moved to quality. It's the same thing we basically did ahead of when we hit the great financial crisis, is that we moved to quality. And when I say we moved to quality, that doesn't mean you reduce your exposure to equity. It just means that you examine your exposure to equity, and you might favor, typically during the great financial crisis, a large amount of money came in globally into the U.S. markets because our markets were considered higher quality than some of the markets globally. So you would look at your portion of U.S. to non-U.S. You look at your proportion of large cap to small cap, because small cap is a lower quality form of equity than large cap. So when I say you go to quality, you move up the market capitalization ladder. Within fixed income, you're going to look at your exposure to fixed income instruments that are backed by governments relative to fixed income instruments that are just backed by corporations, being fully aware that some corporations are larger lately than some governments. But I think that there's a difference between reallocating to quality and reallocating to cash, and that difference is significant.
So cash and quality is very important when you want to diversify your portfolio, and probably cash is very important, especially in times when we see market corrections, and this is what can allow you to get in again, and as we say, buy the dips, because as we know, John, that markets go in cycles. Bull cycles are much longer than bear cycles. I think according to some studies, on the S&P 500, a bull cycle on average since 1960s lasted 51 months. Bear cycle is around 11 months. And if you look at the average returns of a bull cycle, it's around 150%. Average returns on a bear cycle is around 34.2%. So some would ask, okay, why would I need to have fixed income if I know that a bull cycle is always longer than bear cycles? If I do have a time horizon of 5 or probably 10 years time horizon, why should I care and buy bonds when I know that stocks usually continue going up on the longer term?
You know, that's interesting. And of course, when I say allocate to quality, I'm not suggesting allocating to cash. Cash is not investing.
Yeah.
So, you know, you and I both know that money market instruments are yielding still in excess of 4.5% or 5%. So you really have to ask yourself, you know, back earlier this year, end of last year, two-year rate on a two-year treasury would earn you over 4.9%. And so you have to look and ask yourself, are you getting enough of an equity premium to justify the risk? And so what we're going to see happen, my gut instinct is that, first of all, as we see, you know, we went to short term and we went to short-term treasury. And you have to be concerned about the quality of these money markets that investors go into, because not all money market funds are created equal. And we suggest during turbulent times that your listening audience on their money market better check to see whether it's made up of instruments backed by governments or instruments backed by corporations or banks. And the two are vastly different. And during the great financial crisis, you and I both remember that several money market funds busted the butt, meaning that they didn't have the assets to satisfy all the calls. And so, you know, a money market's supposed to be risk-free, highly liquid, short-term. And if you call and ask for your money back from the money market and they say, oh, we can only give you 85%, that's not a good outcome. So when I talk about quality, not only am I talking about quality in the fixed income, not only am I talking about quality in the equity base portion of the portfolio, but also quality in the money market, which many investors look past.
Yes.
And,
Professor Jones, let me ask you this one. So one of the things when I was in the wealth management field, when a client used to tell me, okay, why shouldn't I hold stocks? I tell them, if you can handle market volatility, when markets drop 15, 20, and 30%, and without this interrupting your sleep at night, probably you can do that over the long term. But there's a big part of behavioral impact on your portfolio. When you are worried a lot, you tend to probably start buying and selling and this stuff. So that's why I always see like fixed income is an important portion of portfolio after you assess your behavior when it comes, or your emotions when it comes to investing. But for people, especially closer to the age of retirement, I think it is always very important to have a big portion of your portfolio on fixed income. But let me ask you this as well. when we do see like a market reaction, a drop of 10, 15, 20%, what is the first thing investor need to do?
Well, you know, it's interesting because emotions are emotions destroy wealth. An emotion will cause you want to sell when the market's at the bottom and want to buy when the market's at the top. So the first thing that, you know, an investor has to step back and say, okay, you know, what do I feel like doing? And then 90% of the time they need to do the opposite. So all my students, they, you know, when the S&P is at 54, 5,500, they want to buy. And it's like, you know, so you really have to fall back on the investment science that you and I know so well, and what we've learned over time, and that is that, first of all, tactical investing, meaning trying to time the market, seldom works. And let me be more specific on that. Most people are successful at getting out of the way of the bus, but the problem is they don't go back into the market quickly enough. In my opinion only, a lot of people can say, oh, yeah, well, I feel uncomfortable, I want to leave. Great. The problem why tactical investing does not work is they don't come back into the market soon enough. And so by the time they come back into the market might have retraced 70% of its losses. The other thing that you and I both know very well is that the investment science of rebalancing is so important. And you've got to, so let's assume you're a typical investor at retirement age, approaching retirement age is 70-30. Well, so during this last pullback, their equity probably went down into the mid-60s, and the fixed income went up to 35. And rebalancing would cause you, the science of rebalancing would cause you to take 5% out of fixed income and put it into equities.
I really appreciate these advices, Professor John, and I just would like to add one to this one. And I always used to tell my clients back then in the wealth management that you need to set a clear investment plan and stick to it. Probably in tough times you need to do some tactical changes to the portfolio, but avoid making hasty decisions based on panic and emotions. And usually successful investments also requires a lot of discipline and patience. But thank you very much, Professor Jones, for joining us on this special episode. John Alexander, you are the Chief Investment Officer of Clemson University Foundation. Thank you.
My honor. Have a wonderful day.
ومشاهدينا أذكركم أيضا بموقع البريد الإلكتروني للبرنامج شيفرة المال شيفرة.المال@cnbcarabia.com. أي أسئلة أي اقتراحات يمكنكم مشاركتها عبر هذا الموقع، ونراكم الأسبوع القادم في حلقة جديدة. إلى اللقاء.
هذا البرنامج يأتيكم برعاية ATFX.